You have an extra $100. You know you should be investing it, putting it to work for your future. But every time you even think about starting, you're slammed with a tidal wave of confusing jargon. Phrases like P/E ratios, bull markets, and risk tolerance, along with shady get-rich-quick schemes and 1,000 conflicting opinions that leave you feeling completely overwhelmed and stuck in analysis paralysis. What if I told you that by the end of this video, you will possess a simple, actionable blueprint to transform that $100 into your very first fully diversified investment portfolio in 2026? We're going to silence the noise, cut through the complexity, and give you a clear step-by-step path to finally get your money working for you. Section 1. The most important decision you'll make. Before we even touch that $100, we have to get our mindset right. This is crucial because the single biggest mistake new investors make isn't picking the wrong stock, it's playing the wrong game from the very beginning. For decades, we've been sold the Hollywood myth of the stock-picking genius, the lone wolf who uncovers the next global megacorporation in their garage and becomes a billionaire overnight. The reality? That's not investing, that's buying a lottery ticket. In fact, an overwhelming majority of professional fund managers, people with huge teams, Ivy League degrees, and powerful supercomputers consistently fail to beat simple, boring, low-cost index funds over the long term. So what on earth does that mean for you? It means you don't have to be a Wall Street wizard. You just have to be smart enough to refuse to play their losing game. Instead of searching for that one-in-a-million needle in a haystack, our strategy is simply to buy the entire haystack. This is where the brilliant inventions of index funds and ETFs, exchange-traded funds, come into play. Think of it this way. An S&P 500 index fund is a single investment that holds tiny pieces of the 500 largest, most influential companies in the United States. With one click, you're instantly diversified across giants like Apple, Microsoft, and Amazon. You're no longer betting on a single company to succeed. You're betting on the long-term growth and innovation of the entire U.S. economy. These are called passive investments because you buy them and let the market do the work. They come with incredibly low costs, with annual fees as low as 0.03%, which means you keep almost all of your money working for you, not paying a manager. For a beginner, this is the cheat code to investing. It's the simplest, most evidence-backed way to build wealth over time. So, your first and most critical decision is to abandon the gambler's quest for hot stock tips and embrace the mindset of a long-term passive investor. Section 2. Your step-by-step roadmap to investing $100. Now that we've adopted the right philosophy, let's turn it into action. Here's your 4-step plan to go from $100 in your bank account to being a genuine investor in the market. Step 1. Build your financial foundation. This is non-negotiable. Before you invest a single dollar of that $100, you absolutely must build your financial safety net. This is your emergency fund. We're talking 3 to 6 months worth of essential living expenses, parked in a separate high-yield savings account where it's easily accessible. This is not investment money. This is the cash shield that protects you from life's inevitable curveballs. A sudden job loss, an unexpected medical bill, a major car repair, so that you are never forced to sell your long-term investments at the worst possible time to cover a short-term crisis. Think of it like this. Investing is for building your financial skyscraper. Your emergency fund is the solid bedrock foundation it's built upon. Without that foundation, the first storm could bring the whole thing crashing down. Seriously, do not skip this step. Step 2. Open your investment account. This is the account where your money will live, work, and grow. It's called a brokerage account, and in 2026, opening one is faster and easier than signing up for a streaming service. Most of the best ones have no minimum deposit required to get started. You'll want to choose a reputable, low-cost broker. Industry leaders perfect for beginners include firms like Fidelity, SoFi, or Charles Schwab. They offer $0 commission trades on stocks and ETFs, which means it costs you absolutely nothing to buy or sell your investments. Most importantly, ensure the broker you choose offers fractional shares. This is a revolutionary feature for new investors. It means you can buy a small slice of an ETF, even if one full share costs hundreds of dollars. With just $100, you can still own a piece of the world's best funds, allowing for perfect portfolio allocation from day one. The online sign-up process takes about 10 minutes and will require basic personal information, just like opening a bank account. Once your account is approved and linked to your bank, you're ready for the exciting part. Step 3. The $100 investment plan. What to actually buy. This is the moment where most beginners freeze. Thousands of options, flashing tickers, and endless analysis. What do you actually choose? We're going to keep it profoundly simple and powerfully effective. Remember our rule, we're buying the haystack. For your first $100, a fantastic starting point is a single, broad market ETF. A perfect example is the Vanguard Total Stock Market ETF, with the ticker symbol VTI. This one fund gives you ownership in a piece of the entire U.S. stock market, over 3,500 companies, including large, medium, and small ones. It's the ultimate diversification in a single, easy-to-buy package. As of early 2026, it has a tiny expense ratio of just 0.03%. To put that in perspective, for every $1,000 you have invested, you're only paying 30 cents a year in fees. So how do we build a portfolio from this? A classic, time-tested rule of thumb for beginners is an 85% stock and 15% bond allocation. Bonds are generally more stable than stocks and act as a cushion or a shock absorber when the stock market inevitably gets rocky. They provide stability and help you stay the course. With your $100, your first portfolio could look this simple. $85 into a total stock market. ETF like the Vanguard Total Stock Market. ETF VTI. $15 into a total bond market. ETF like the Vanguard Total Bond Market. ETF BND. And that's it. You are now officially an investor. With those 2 clicks, you are more diversified than someone who owns a handful of individual stocks. You own a piece of the entire U.S. economy and its bond market. You just built a balanced, sophisticated, long-term portfolio in a matter of minutes. Mid-roll CTA. Hey, just a quick pause. If you're finding this valuable and finally feel like investing is something you can actually understand and do, please do me a quick favor and hit that subscribe button. My entire mission is to demystify finance for everyone, and your support helps this information reach more people just like you. Section 3, the golden strategy, how to build wealth on autopilot. You've made your first investment. Take a moment to congratulate yourself. But the real life-changing secret to building wealth isn't just about that first $100. It's about what you do next month, and the month after that for years to come. This brings us to the most powerful and reliable strategy for beginners. Dollar cost averaging, DCA. It sounds technical, but it's beautifully simple. You invest a fixed amount of money on a regular, predetermined schedule, regardless of what the stock market is doing. For instance, you decide you're going to invest $50 every single month. Here's why this strategy is pure magic for long-term investors. When the market is high, your $50 automatically buys fewer shares. But when the market dips and prices are on sale, your same $50 automatically buys more shares. Over time, this process lowers your average cost per share, and most importantly, it removes all the emotion and hazardous guesswork from investing. You're not trying to time the market, a proven fool's errand. You're just consistently buying month in and month out, turning market volatility into your ally. So here's your action plan for building wealth automatically. Look at your personal budget and find an amount you can comfortably and consistently invest every single month. Whether it's $25, $50, or $100, the consistency of the habit is far more important than the initial amount. Log into your brokerage account and set up an automatic transfer and automatic investment. Schedule that amount to be moved from your bank to your brokerage and automatically invested into your ETFs, like VTI and BND, on the same day each month. Set it, and then do your best to forget it. This is the financial discipline that separates successful, wealthy long-term investors from short-term gamblers. Section 4. The final rules of the road. Moving forward, you just need to internalize a few golden rules to stay on track and protect yourself from your own worst enemy, your emotions.
Rule number 1. Think in decades, not days. Investing is a long game. The market will go up and the market will go down. There will be terrifying headlines and panicked news reports declaring the sky is falling. Your job is to ignore the noise. Do not panic sell when the market drops. Every market downturn in history has eventually been followed by a recovery that reaches new all-time highs. Your automatic investing plan is specifically designed to take advantage of those dips by buying more shares at lower prices. Trust the process. Rule number 2, ignore hot tips and FOMO. Your friend, your cousin, that random person on social media, they will all eventually have a hot stock tip for you. They'll tell you about some obscure crypto coin, a new meme stock, or a speculative startup that's guaranteed to go to the moon. Ignore it with disciplined resolve. Chasing hype and reacting out of a fear of missing out is the single fastest way to lose your hard-earned money. Stick to your simple, boring, diversified plan. In the world of successful investing, boring is beautiful. Rule number 3, review, don't obsess. Once a year, it's a smart practice to check in on your portfolio and see if your 85-15 asset allocation still makes sense for your goals and timeline. This is called rebalancing. For instance, if stocks had a great year, they might now be 90% of your portfolio. You would simply sell a small portion of your stocks to buy more bonds to get back to your 85-15 target. But please, for the sake of your sanity, do not check your portfolio every day. It will drive you crazy and tempt you into making emotional, wealth-destroying mistakes. Your automated plan is doing the work for you. Let it cook. Conclusion. Let's bring it all home. Investing in 2026 does not need to be some complicated, intimidating puzzle. You don't need a degree in finance, you don't need to be a math genius, and you absolutely do not need a fortune to get started. All it takes is $100, a simple, proven plan, and the discipline to stick with it through thick and thin. And now you have that exact plan. Open a brokerage account with a low-cost provider like Fidelity or Vanguard. Set up an automatic recurring investment into a simple portfolio of broad market index funds like VTI and BND. And then let the power of time and compound growth do the heavy lifting for you. The person who starts today with $100 and invests a little bit each month will be financially unrecognizable in the decades to come, compared to the person who waits for the perfect time or tries to get rich quick. You have the roadmap. The only thing left to do is take that first powerful step. Thanks so much for watching. If this guide was helpful and gave you the confidence to start, please give this video a thumbs up. It truly helps the channel grow and reach others. For your very next step, check out this video right here on the biggest mistakes that beginners make, so you can avoid them from day one. Now go take action, and I'll see you in the next video.